All right, so I've done some videos on the idea of this being a stock picker's market. The reason we say that is because, well, you have stocks all over the place at the moment, and some of them are going to take longer to recover. Some of them should recover or will be able to kind of weather the downturn here. Did a video on Monday where you can see the sort of Goldman Sachs reference of picking tech stocks in different categories. And actually last week we did a video on breaking down the transport sector and kind of narrowing down into Martin Transport to kind of show you how you might want to look through the different sectors rather than just go out there and be a passive investor. Doesn't mean it's a good fit for everybody, but for those of you that are more active investors, I thought I'd kind of carry that forward and maybe talk today about the financial sector. Let's assume that you want to be a investor in the financial space, but you're like, I don't know. There's so many names out there. I don't know where I need to focus. So today we'll break that down. All right. So we're doing a kind of a top-down analysis here where you start with the stock market and you go, okay, maybe I could just invest in the whole market, pick an index fund and go from there. But what if you said I want to invest in a sector like the financials or like we did before, the transports? Well, you have a choice of using these sector ETFs. There's a lot of great ones out there that focus on financials, whether the big banks or regional banks or however you want to put them together. Chances are there's an ETF for anything there. But what we thought we'd do is look down into the major financials because there is a distinct difference that you can, after doing a little research, you can actually kind of dive in. So I'll give you an idea of how I would look at this, and by no means is this a recommendation in any way. So what you'll see on the screen there is actually the chart of how Goldman Sachs has underperformed the other financials. In particular, what you're seeing is JP Morgan and Bank of America over the last 5 years. You can see Goldman Sachs there at the bottom, particularly in like 2017, they started to underperform. The reason for that is they chose not to focus on lending. They were given a lot of grief for doing this at the time. In fact, in the first quarter of 2020, 60% of their revenues came from trading. Now, Goldman Sachs is not necessarily a bank that lends out money. 60% of revenue came from trading. They do a lot of fundraising for companies. You're seeing that lately, where they help other companies raise money. They take a cut of it. They do a lot of bond issuing for state and local governments, municipalities, things like that. And they're also focused on the M&A space, like mergers and acquisitions. When one big company wants to buy another, they handle that transaction, and that's how they generate revenue. Well, if you look at something like JP Morgan or Bank of America, they've made a switch and have always kind of been, Bank of America anyways, has been in the lending space. JP Morgan, you may have noticed, putting up the Chase banks everywhere. They like a physical location. And in fact, their lending, the amount of money that they've lent out, hit a high in the first quarter of 2020. Maybe bad timing there because now with the virus, assuming that people will not go pay their loans, or there'll be a bigger percentage of people that won't be able to pay their loans, at least that's predicted at the moment, JP Morgan has set aside $8.3 billion to account for that. They put aside that cash figuring that's what they're going to have to write off. You see that on the screen there. Between Bank of America and JP Morgan, that's over $10 billion that they put aside. And CNBC says this is just a down payment, meaning they're going to have to put a whole lot more into the mix there. JP Morgan CFO actually said that the amount of money that they'll have to put towards writing off bad loans will probably be meaningfully higher than what it is now, meaning the $8.3 billion they've already put aside. So what have you noticed out of all these names here? Well, if you look at Goldman Sachs, just from the coronavirus high, which we'll show, you notice that Goldman Sachs didn't sell off as much. See, markets have already priced that in. Markets have already assumed that Goldman Sachs will weather this downturn a little bit better than some of the other stocks because they don't have that exposure to lending overall. So if you look at the other stocks, they're down over 30%, a lot of them even more than that. So in the stock pickers market, if you just bought the XLF, which is the sector ETF that focuses on the large banks and financial institutions there, you'd have about 20% in JP Morgan and Bank of America, as you can see. If you add in Wells Fargo and Citigroup, all of a sudden you've got a 35% exposure to banks that have, well, a lot of exposure to dividend stocks, or not dividend stocks, but bad loans potentially. So one thing to kind of pick from this is to say, well, all right, if I want to invest in a financial, but I don't want the exposure to potentially bad loans if this virus thing continues or whatever, then you might focus on something like Goldman Sachs. Obviously, what we've shared here, a little bit of research shows that if you were to pick a Goldman Sachs, you now know that you have that less exposure there than if you were to pick a JP Morgan, a Citigroup, Wells Fargo, Bank of America. Now, Goldman Sachs, the company has actually said, we have goals in the midterm and the long term. Those goals have not changed. It's not that Goldman Sachs doesn't want to get into lending. They just chose to go about it a different way. And they do want to get into lending, and they have with their offering like Marcus, which is by Goldman Sachs, the high interest savings accounts. But they're going to do it rather than having physical footprints like Chase. They're going to do it by having a more digital exposure, which they've experimented with quite well, actually, with Marcus by Goldman Sachs, their savings accounts there. So that's your breakdown for today. We start at the stock market and say, I need to be more of a picker. I want to be choosy about the investments I have. If that's you, you go down to the financials and you say, okay, well, what's better than another given the current environment that we're in? And now you know maybe bad loans getting higher and higher and higher. Maybe you want to stay away from that. I don't know. I'm not telling you. But you look at Goldman Sachs and you say, well, that's a company that stayed away from this. Hopefully that helps. Just a real short one here for you today to try to break things down a little bit differently. Let me know what you think. Is this the kind of thing you like? You want to continue focusing on this sort of analysis? It's tough for me because I can't give specific recommendations, but I can sure provide you all the research and stuff that we do here, and you can make your own choices unless you want to join us here at Jazz Wealth. We manage our own funds, which means we can choose the stocks that go inside those funds, and you can see that along with the performance and everything right on our website. I will thank you for watching, and have a great day.